say we get started on the conversation?
I think we should. I mean, when unknown participant is joined, that's the cue to get started, I think. I love it.
All right. So, the last CECL roundtable, we discussed more, I would say, in a formal training type environment. With this one, we've intentionally not prepared a PowerPoint or materials that will be shared on screen. Hopefully, after this, we will be able to send something out. But our thought here was kind of more focused towards a FAQ. And we've received a lot of questions informally and a few more formally. And in dealing, with year-end audits and being out there in the field and present and those kind of things, a lot of, other things have kind of come along. We're trying to, frame this in a more, I think the way Jeff worded it, last 30 days type versus the initial guidance and technical interpretations and those kind of things. So I encourage all of those that are present to feel free to unmute your line whenever you have a question, chime in. If you have any feedback or, there may be questions that you can answer better than us, because we've had a lot of discussions, and sometimes it comes down to, well, how does it look when you input it into the software system and those kind of things? And we haven't dug into the weeds yet to exactly know how every system works. But I think, Jeff, you have any comments you want to add before we start kind of talking through some of the questions we've had?
Yeah, I mean, really over the last month or so, the nature of the questions has changed, as Mark said. There used to be a lot of questions about the modeling and the details of the loan number crunching process. Now the questions are kind of different. Some of them are about basically the tone is, now that I have my number, now that my modeling and the number crunching is more or less complete, and I know what my CECL number is, what other stuff am I supposed to talk about and think about related to CECL adoption? A lot of the questions are about investments, for example, other things on the balance sheet where you may have to think about CECL besides loans. And there certainly are more questions about the loan part of this, particularly on disclosures and things like that. So I think we're going to get into some of that this morning. And like Mark said, we're open to whatever questions you have about any part of CECL. We're happy to chat through some of those, and hopefully we'll be able to shed some light on some of this stuff collectively.
Yeah. And I mean, we've been learning along with all of you for the last 7 years, and it's obviously constantly evolving. And right when you think you've got things figured out, new guidance comes out or new questions come along that you hadn't seen before. So we're if there are questions we're not certain on, we'll add those to our follow-up response in this FAQ document we're building out right now. So, Jeff, kind of looking through some of the initial questions that we received and have put together here. The first one I have here relates to is the new ACL notably larger than it was under the old pre-CECL ALLL method? How would you respond to that one?
Yeah, I think this is really the most common question over the last month or so is, now that I have my CECL number, how does it compare to everybody else's CECL number? And there's this sort of, it's not easy to answer that question necessarily, because people try to think about in the context of, well, my old allowance number was X, and my new CECL number in comparison to that is 20% higher, or it's 10% lower, or it's and people are trying to say, well, is that what everyone else is experiencing? And it's really hard to answer that question, because what's coming out of that discussion is that people were doing their allowance under the old methodology in different ways too. So it's not like everyone's starting at the same point. Some lenders had a more conservative approach. to the allowance under the old methodology, whereas others had perhaps a less conservative approach. So it's difficult to, if you will, benchmark yourself against other lenders and say that, oh, well, you know, in general, everyone's CECL credit allowance is 20% higher than their old allowance for loan loss. That's not really meaningful necessarily, unless you understand how the other lenders were doing their allowance under the old methodology. So I think many lenders have seen an increase in the overall credit allowance as compared to the old allowance for loan loss, but not all of them. And some it's been fairly consistent with the number from the old methodology, and there's a few where it's actually lower now under the new CECL modeling. So I think you have to get into some more specific details about, you know, how conservative or not conservative was your old allowance modeling in comparison to what you're doing now under CECL. And I know that's kind of like a non-answer to answer the question, so I apologize for that. But it's very hard to generalize across the entire industry to give you like a benchmark of is it reasonable that your allowance is 20% higher than it was before? Well, it probably is, but you have to get into a little more detail to specifically answer that question.
Yeah, and it seems like that has been a moving target. You know, initially in 2016, when the guidance came out, everyone expected a significant increase. And then as we move down the line and as people have run parallel, it hasn't quite materialized the same. With, you know, COVID hitting right after the implementation of the 150 early adopters, that had an impact, a significant impact, and there was some disparity between the CECL and non-CECL. Looking out, you know, over the subsequent 18 months or so, that's where they started to move a little more closer and in line with each other. But the CECL adopters from 2020 have consistently been ahead of the historical ALLL users. And again, there's size differences and the portfolios all look different, but the general consensus is that CECL should result in a higher allowance, but we're talking, you know, basis points, small, single, double digit, not triple or anything like that we've generally seen. And then I think the timing of it right now is sort of unique as well, in that across the board, again, based on the publicly available record, and FDIC puts out good summaries of this information too. You know, towards the end of the year, the ALLL trending upward. You know, it's a weird environment with obviously all the rate hikes, and now the economic forecasts looking not as good for 23 and 24. Not just in the US, but globally. That's all going to factor in, and it should factor in more on the CECL side than it may have on the historical incurred loss model. So I would start to anticipate an increase that may not have seemed as likely 1 year ago. But, you know, we didn't have our crystal balls out at the time. So, you know, we've seen this question for many years, but the question of whether or not to build up the ALLL in anticipation of implementing CECL. And I thought we talked about it a lot, but I've still seen some that are keeping their unallocated reserve at a higher level than they may need to in the old ALLL method. And I know, you know, with call report deadline passed, most have filed and don't necessarily want to make changes or amend. But just the monthly reminder, you do have, first of all, you do have to have support for the old gap, but also the regulatory relief available related to a 3-year phase-in for capital purposes is the advantage of not building in that reserve And you get to slowly phase in that increase, if significant, over the next 3 years with your call report. And this is just regulatory capital, nothing to do with, financials. So Jeff, there was not a question in there for you, but if you felt there was something, go ahead.
No,
right, Jeff.
no, I think you covered it. Did somebody else want to make a comment there?
Yeah, I was just curious, how do you slowly phase it in? Like if it's like triple what you normally would allocate, what do you mean you can slowly, like I can do a percentage and say this is showing a large increase, like document why we're not going to use the full amount?
Yeah, I believe it's going to be built into your Q1 call report.
Mhm.
And if you show that you had an increase from the ALLL to the ACL, that amount would then, I assume it's in the, not a call report expert, but the RC section there, where you report your capital and the add backs and the various capital types. I think in there will be an option to elect to phase that impact in over the 3 years. So then when you report each subsequent year, it'll take it up and up and up.
Yeah, and it's important to know this is a difference between GAAP reporting and regulatory reporting. So this is not, you don't defer this over 3 years for GAAP purposes, but the regulators are allowing you to do that on your call report to ease the effect on your equity and everything else of adoption. And whether that's a big number or a small number, you can still elect this 3-year phase in for regulatory reporting purposes.
Okay.
Yeah.
And then is everybody still doing like their regular ALLL this month and then comparing it to the new CECL model? Anyone else on the call working on that today? Because it's the first.
We did it for the last year. We just
Mhm.
did it each quarter for the last year.
To compare them, Maria?
Yes.
Okay. Gotcha.
Yeah, each quarter, yeah, to see what would happen. And they were comparable. We were pretty much the same.
Okay.
Yeah, we've done the same thing. This is Kevin. We're kind of seeing the same results. We're not really seeing large changes, but we've been running parallel since August. But yeah, we did our 1231 as 1231 ALLL and now adopting CECL 1.1 and calculating and figuring that information out, but not seeing significant changes. So Mark, just you'd mentioned the GAAP, for GAAP purposes, we can't take it over 3 years. It's only for regulatory call report purposes.
Correct.
What about qualitative? Qualitative, when you evaluate it for CECL purposes, is it at a point in time, or you're supposed to also factor in current expected credit losses? So you're looking more at a point in time and maybe factoring in potential future impacts, whether it be economic or, some of the other 9 related factors. So I guess you're supposed to factor in future anticipation. So if you see low delinquencies currently, but you assume economically there might be a recession, the quantitative's factoring that in, but as your qualitative should be look at forward moving also, I guess is what I'm asking.
My general understanding would be yes. I haven't dove into one of these yet where I can tell you exactly which buttons to click to make the model update to reflect that. But yeah, the qualitative over the last, pretty much since CECL has been since COVID has been the big discussion item, because it was initially, how do we pick this up in CECL? And that's when the Q factors kind of took off in the new model. Whereas before that, there wasn't as much talk of them or potential impact. That's been my general read on it.
Yeah, one of the challenges that we're hearing about from lenders is that budgeting for 2023 has been really challenging, because do you think there's going to be a recession? What do you think is going to happen with rates? But there's a lot of sort of uncertainty about changes that may happen in the short term that could affect your expectations for 2023. We heard about that as organizations were going through their budget process in November and December. But now with CECL, the assumptions going forward in some of these factors really should be consistent with whatever your expectations were for everything else that you were thinking about for budgetary expectations for 2023. Having expectations in your budget that are totally different than your expectations that build into your factors for CECL would be kind of inconsistent. Now, that doesn't mean you can't change things, because obviously as we go further in time, you might have better information. But that's where it comes down to documentation in the context of, yeah, our budget called for this to happen, but now that we're in February, we feel like something different is going to happen, and here's why. So it really comes down to a documentation exercise when we're talking about these factors.
Related to the call report, I did recently, last week, receive a question on if and how the call report will be updated to reflect the new TDR guidance. And in looking into the instructions there, thank you, Kevin, Rody, at this point, they've indicated that it will be updated. I don't have the exact wording in front of me right now, but the agencies plan to revise the call report forms and instructions to replace the current TDR terminology with the updated language from ASU 2022-02. So I think that will be included again in the Q1 call report instructions, hopefully guiding you how to report those in there versus the old TDR designation. Jeff, what about note disclosures under CECL? What
Yeah,
is there any opportunity to simplify or reduce some of the old notes here? And what are you thinking there?
there's a lot of, again, as people get more comfortable, if maybe comfortable is not the right word, but comfortable that they have their number now for CECL on the loan side, there's time now, I guess, to think about the other elements, which includes the note disclosures. And people are realizing that there's some very significant tables and things that are required to be disclosed now under the CECL requirements in your footnotes that are perhaps quite a bit different than what we had historically disclosed, even though that footnote has been quite long historically as well. And so the question comes up, is there a way to sort of shorten this or shortcut it or apply the concept of materiality to say that maybe we don't need to do all these tables and things? And I mean, the answer to that is really that materiality does apply to this, like it applies to anything else. But going through the exercise of understanding what those disclosures are and how you need to compile information to satisfy those disclosure requirements is kind of important. You may have time for that because if you are only doing a full-scale external GAAP report on an annual basis, you won't have to do that till the end of December 2023. If you're doing a more full-scale reporting on a quarterly basis, then you don't have quite that much time. But fleshing that out during 2023 and not waiting for your audit cycle to happen next January is definitely advisable. We have examples of this from the public banks that adopted CECL, a couple of years ago. So it's not like it's blazing a totally new trail, but understanding that you have the capability of compiling the data in that way is really important. Some lenders used an outside vendor for their modeling, and the tool that does the modeling actually will produce the data that needs to feed into these disclosures. If you haven't really explored that part of your modeling tool or the vendor tool that you're using, it's a good time to do that. And we're kind of recommending that as this year's audit wraps up and you maybe have time to think about this, it's really time to poke at that in more detail in terms of getting those footnotes together, understanding what is kind of already baked into the product that you have in terms of producing those disclosures versus what you may have to do some kind of workaround or some additional effort to get those together. Only after that can you really evaluate whether something is immaterial enough to not disclose. So you have to have some kind of basis for saying that. So our inclination is to recommend look at all the required disclosures, try to fill out all those tables and satisfy all those disclosure requirements. If it turns out that one of them is really immaterial, you could make that case, but without some data and some information, it's really hard to just say right off the bat, I'm just going to say some of this stuff's immaterial and not do it. That's not recommended. So there is another, it's kind of like another stage of implementation. Now that you have the CECL number, do you have the capability of producing the required disclosures? And if you're in this position where you don't know the answer to that question, I think you're in the same place as a lot of folks in terms of not having explored really the full scope of what those disclosures are and how you're going to fill them all out. Does that make sense?
Yeah, and in addition to the large public banks that adopted 3 years ago, we will have quite a few of the smaller public banks adopting Q1, so there will be some more fresh data out there in templates and such. There are certain reporting requirements that are slightly different for footnote purposes for the public versus non-public, specifically, I think related to the vintage tables. But we, as long as we understand what is required and what isn't, that should help us there. And Jeff, because you talked about model validation, and this seems to be a recurring question that we're getting last session and standalone a lot, and I think there's tons of confusion out there, but the question is generally related to, do we have to, if we're using a third-party vendor and software product, do we have to have the model validation performed? What is a model validation, and how often do we have to do it? Before you give me your thoughts on that one, I'll just say historically the regulatory guidance for model risk management was governed by a joint Federal Reserve and OCC guidance, regulatory guidance that fell under SR 11-7, and that was released in April of 2011. And then last year, the Federal Reserve, FDIC, OCC, in consultation with, what was it, the FFIEC, I think, FinCEN, in consultation with FinCEN, they came out with an interagency statement on model risk management that really updated the 2011 guidance. And this one more specifically was related to BSA, AML, and OFAC. But they do talk about how, the general guidance on model risk management, this impacts all models, not just those ones, even though there were some specific items in there related to this. So while there's not necessarily regulatory requirements, these are guidelines that they generally follow in the exams. So the 21 interagency guidance really further cemented that if it's a model that is fairly insignificant, little risk, you probably don't have to take a robust approach, and you may not even have to do anything. But for, I think the exact wording I had written somewhere, but for something that has a material impact on business decisions, risk management, and capital and liquidity planning, and when failure of the model would have a particularly harmful impact on the financial institution's financial condition, operations, or compliance, a more extensive and robust model risk management framework would likely be appropriate. So they won't commit to saying you need a validation, but they're sort of saying you need to do something to review and assess. And I think our general guidance has been implementation. You would want to do some sort of validation there. And then on an ongoing basis, when a model's generally established and working and not many tweaks or any issues with it, it seems you kind of move into that 3-year cycle. But initially, it seems best practice would likely be at least annually for a year or two before moving to that 3-year cycle.
Yeah, I'd add to that it seems almost like a slam dunk that examiners are going to ask you how you're confident in your model. And if you just say that it's, well, the vendor who is doing the model for us says it's fine, they're going to say, well, of course they say it's fine. They're the ones who did it. So this idea of an independent validation of the model almost seems like a no-brainer kind of finding that the examiners are going to point out to you if you don't have it. So this validation, while
Jeff,
Mark's
do you have
correct, there's
any,
no, oh, I'm sorry, go ahead.
just a question, do you have any, if they can't provide us with like an audit or a SAS, like, we're with Encino, how do we validate their model? And like our ALM models, we usually get another vendor to produce hire them to produce another look at our ALM results and compare them. We really can't do that with CECL. It's just not practically possible. So how do we validate their model? I
think that's a great question.
To do that.
Yeah, and I think that how this is gonna play out is that it is going to be possible to do something called a validation. Now, it won't be exactly the same as what you do for ALM modeling, but it will be similar to that. And there will be it will have to be done by a third party. Like you can't just get it from Encino if you're using Encino, because they're not independent of the model because they're too heavily into it. Management can't do it either because you're too heavily into it and related to it. So, so it would have to be somebody else, perhaps a CPA firm would do this. And we are entertaining that possibility that we'll be involved in some of these ourselves. But I think that it's not, you're right that you can't do it the same way you do it for an ALM model, but the concept is the same in the terms of, can someone come in, validate your inputs, your data inputs? Can they validate the methodology and the calculations? That's a little bit harder when it's all sort of inside a black box of a vendor's product, but it's something that is possible to do. And then looking at the reasonableness of your assumptions and other inputs in terms of Q factors and things like that, and your documentation that supports all of those things, that is possible and that is covered. And I'm not going to quote the actual regs that Mark did because I don't remember that stuff. But yes, there's actual guidance out there that's general enough that it could be applied to any kind of modeling. How that actually gets fleshed out and done and executed is still not totally clear. But I think that from an examiner and regulatory standpoint, doing nothing is probably not going to be sufficient. That's the messaging from the regulators at this point. But you're correct; they haven't put out guidance specifically about what this is supposed to look like. But the vibe they're sending out is very clear that doing nothing or having no independent view of this thing is probably not going to be enough. Does that make sense to you, Mark, in terms of what you're hearing?
Yeah, and in the 2021 update to the model risk management guidelines, they did emphasize exactly that word you keep using, independence. They touched on the fact that, the algorithm data might be proprietary in nature, and I think sort of what Leanne was driving at, you don't necessarily have access to that. So that they'll factor that into your limitations and how you scope the work. But they did stress that it should be conducted by someone independent of the user.
Yeah, we use Quick Rate CECL solver, and we requested this information already, and they provided us with a report from Bar Advisory, I guess sort of akin to our ALM model validation, but not the same thing. But they actually were able to provide an independent model validation when requested, because they said it's been requested before for early adopters who've adopted the model.
So the vendor provided it?
The vendor provided the report of an independent third party who had performed this assessment. And they called it a SOC 1 report, and we said that's not what we need, but they said no, this has been provided to regulators and externals in the past for model validation. So who knows? I mean, it's a starting point, but they were able to provide us this independent model validation report of the CECL quick analytics CECL model when we requested it.
Is that for your bank specifically, or was it related to just their general software?
It's related to the general software. They didn't do this for us specifically. This is their independent
Right.
third-party validation report.
Yeah, so I think, I mean, in the context of what you're describing, all of those are parts, those are ingredients in responding to this expectation from the regulators. I think that if it's actually titled the SOC 1 report, it's going to focus more, SOC 1 reports by their nature focus more on the controls over the process, which is definitely part of the equation in terms of looking at your model and the reasonableness of it. The model validation expectations that we understand at this point are going to be more specific to your actual calculation in terms of the data, and not just the controls over the vendor's software, which is part of that, but also the controls over the data that you're providing and inputting into the software, the assumptions and things that you're putting in and the documentation around those, as well as the elections you've made for the options in the modeling under CECL. There's a lot of options that you could choose from, how you made those choices, and then what you did with the output in terms of how it comes out. So I think what you described there as the SOC 1 report is part of this. It may not be the entire answer that the examiners and regulators are going to be looking for as this sort of gets fleshed out throughout 2023.
Yeah, and Jeff, I believe in the April 21 guidance, they talk about kind of the model risk management assessment going sort of hand in hand with your vendor due diligence work. And generally with the SOC 1, that would definitely be something that you'd want to have if available for new vendor audits, vendor security, those kind of things, and ensuring that you've implemented all the complementary user controls and such. But the validation seemed, at least my understanding is, yes, them having one would be great. If they don't, if you have a SOC 1, that's probably goes a long way towards data security and those kind of things. But the guidelines are sort of, it seems indicating that you should have an independent one. Again, this is not all regulatory agencies were in on these guidelines. So I guess that's one thing to note. Second is they're not regulatory requirements that are cemented into law, just guidelines. And then the last thing is, what was I going to say? I can't remember the last thing I was just thinking, but keep in mind at this point it's sort of a best practice recommendation. But I would try and if there's a way, try and feel out your regulators to see if they can give you any encouragement in which direction they'll ultimately lean.
Mark, can you discuss the, I think it was noted earlier about when you're looking at your ACL, the investment portfolio, is it specific to the held to maturity portfolio only? And would you be looking for, I guess, documentation and support, I guess is what you continue to tell us, to prepare and evaluate for, I guess, investments for CECL?
Yeah, so with investments, it definitely seems that this is sort of last on the list as we finalize our plans. And with CECL sort of replacing the OTTI analysis, and I don't see Kevin's eyes rolling yet, so I haven't said anything wrong, but it impacts AFS and HTM, I believe. And the recording of those and the presentation changes slightly as well, where, on the face of the statements, you'd have for your fair value ones, AFS, you'd have the original cost and an allowance, I believe is what I was seeing the other day. And then for HTM, it would be more in line with the old OTTI analysis, whether or not you'd have to push an adjustment through. And I think, Kevin Rohde, we were talking about this morning, so feel free to unmute yourself. But I think the allowance on the AFS would push through OCI until maturity. Am I correct on that one, Kevin?
Yes, as long as, you'll have to do an analysis in terms of whether, I'll use OTTI because it's the terminology we're all familiar with, but if you consider it to essentially be other than temporary, you would then push it through your P&L just like you would under the OTTI rules. But if it is considered a credit, and this is credit related only, obviously you still have your fluctuations as a result of, interest rate risk. So if it's determined that, you have the intention to sell that security, or if that credit risk of that institution that you're holding the security with is deemed that it's not going to, rebound, then you would have to recognize that through the P&L just like you would right now under the OTTI rules. But it will be, right now, I think that one of the bigger differences is right now we mark that security, directly with a change to the balance of it, if it's OTTI or if it's interest rate related. Under the new guidance, it'll actually have an allowance similar to your loan securities. So, but again, only related to the credit risk. You'll still mark it to market based off the fair value that's associated with interest rate risk fluctuations, as you always have.
And that allowance is what I was reading will be required to be presented on the face of the statements, parenthetically though, not
right
as a line.
And another thing to add, I know a lot of our clients on the call here, maybe have differing portfolios, but for the most part, many of those portfolios consist largely of what we would consider to have very little or no credit risk securities, such as treasuries, municipalities, and things such as that. So I think, it'll be important to document your analysis of that, but the expectation would be you're not going to end up with some large amount of allowance related to these portfolios, because for the most part, we have rather conservative portfolios held by our clients that aren't, having these securities that would otherwise have large credit risks attributable to them.
One of the bigger categories of questions that's come up over the last month or so is, how do I document my consideration of credit risk on the investment portfolio? It's quite different than what you did on the loans. The loan was very data focused and number crunching focused. On the investments, to Kevin's point, if you can go through your investment portfolio and say that, treasury securities are backed by the full faith and credit of the United States federal government, and therefore we're assuming zero risk. Most institutions are putting together some kind of a memo that basically lays that out for the different categories of investments that they hold, whether they're federally backed or there's an implied federal support backing for some of these like federal agency type securities. When you get into something like municipal bonds and there's no federal involvement whatsoever, people are referring back to rating agencies reports and things like that. And even some of the less backed things, like maybe like banknotes or corporate paper, those kind of things. We're seeing people go for public information that's available either from rating agencies or I had one client who's holding some banknotes from some of the bigger banks, and they found those banks stress tests, the mandated stress tests that big banks have to do, and just looked at that and said, well, under this super stressful scenario, they're still okay. So we're going to use that as part of our evaluation of the credit worthiness. Putting this together and documenting all of that. Again, I hate to keep coming back to documentation because I know it's no one's favorite topic, but it's the kind of thing that really is important, especially starting with this analysis in 2023, understanding that if you establish that practice of documenting this stuff effectively, it'll just cover your risk when people start asking questions about how did you come up with these conclusions. So establishing a process to evaluate the creditworthiness of these things. And to Kevin's point, for most of these, you're going to say that we have zero credit risk on these things, and that's okay. That's perfectly acceptable. But having some documentation to support that, even if it seems obvious, is worthwhile at this point.
And I mean, most of the institutions I've worked with have over time developed fairly robust OTTI memos and assessments quarterly. So it should sort of follow that similar guideline. Obviously, we'll need to reflect new names and words and such, but that will sort of be the support behind the scenes then flows into the model if necessary. But yeah, it almost sounds to me like a flow chart. Is this backed by U.S. government or someone with similar authority? Yes, no, and then move to the next step as appropriate. And I think that'll kind of flow right into your model, hopefully eventually.
Yeah, and the other component to ensure, you're documenting for the regulators and your auditors is, in relation to the intent to sell. So, that distinction still exists. So it can't just be that it's, there is no credit risk because it is a treasury security or what have you. You also have to document that you have no intent to sell the security and you're not going to be required to sell it. So, making sure that you maintain that documentation surrounding that analysis will be important as well.
Another question that we're starting to see in more frequency surrounds unfunded commitments and how those are treated under CECL. And under legacy GAAP, as a reminder, I know some have them and some don't, but the off-balance sheet reserve technically is supposed to assess all the unfunded commitments, determine a reserve, and then it's actually presented in other liabilities, not with the ALLL. Jeff, do you want to speak to some of the new guidance on that?
Well, yeah, I mean, back to what I was saying before, if your expectations for unfunded commitments have to be aligned in some level of consistency with your expectations for 2023 or the next year or so that are baked into your budget and your other elements of your CECL analysis. So if you have included in there that there's going to be an economic downturn, and you can look back at data from past economic downturns and say that, well, when an economic downturn happens, our customers draw down some of their lines of credit, and then if that downturn sort of becomes longer duration, some of those drawdowns are going to go bad on us and ultimately end up in charge-offs. You have to consider that effect of that now in your go-forward projections. There's a couple, well, more than a couple complicating factors to this. one is downturns aren't always the same, and the behavior of those is hard to predict. Two is that if you have provisions in your line of credit agreements of different types, that you can cancel a line of credit if you feel that there's a change in that person's creditworthiness or that customer's creditworthiness, then you may not have to worry about extending those unfunded commitments because you may be able to cancel them before that customer draws it down. So that's one of the big variables that people are leaning on in terms of not having to go through this exercise. But understanding that this is part of CECL in terms of expected performance of the portfolio. If people have the ability to draw down lines, and then you believe those lines are in jeopardy in terms of credit risk, recognizing that credit risk as part of your credit allowance now, even though you haven't lent out the money as of today, it seems kind of odd, and there are people who are pushing back on this, but that's really what CECL calls for in terms of the analysis.
Like with everything else, obviously, materiality will play a part in all of this, but it is difficult to assess the materiality without first quantifying it. So that's the challenge in that.
And we're also finding among a lot of lenders that we're talking to that the modeling that they've done, or the vendor that they've worked with to do their modeling, doesn't have this unfunded commitments element in the model. So that's a challenge point because now you have your whole loan portfolio being analyzed through this model and it's giving you the number, but now you have this other piece that you may have to layer on sort of offline, which presents challenges of how do you work that into your process on top of the challenges of what assumptions do you put into this kind of an analysis. So again, I would suggest that if your outlook for 2023 that you've already documented in your budget and your other stuff calls for an economic downturn, having some thought into what that might mean for your unfunded commitments is important to make sure that you're covering all the bases on CECL. I'd like to share some better news. Does somebody have a question that we can answer with like wonderful, wonderful news?
Jeff, when do we have to make the entry for the difference in our CECL model and our old ALL calculation?
Yeah, so technically you would make that entry on January 1st, 2023. From a practical standpoint, because the first time you're going to report this externally, most likely is on your first quarter call report. You kind of have some leeway to just make sure it gets booked in the first quarter, but technically the date of that entry should be 1/1/23.
So whatever report they ran for end of December, I'm gonna take that number and subtract from my ALLL, and that's the number I'm going to give to my accounting department for the entry for the difference between the two starting January 1, even though that number may change by end of quarter.
Yes, because you're gonna wanna record the impact of that to retained earnings, that initial entry, whereas your change over the quarter will go through your P&L.
Okay, that makes sense. Okay, thank you.
And back to our earlier conversation about deferring the effect of that entry over 3 years, again, what we just talked about was booking that whole entry on January 1st, because that's what you have to do for GAAP purposes. If you're going to defer it over 3 years for regulatory purposes, that's going to be off the books kind of. So you're going to have this GAAP versus regulatory accounting difference that is not most likely not going to post to your general ledger, but you're going to keep track of that sort of offline and incorporate it into your call report preparation on a quarterly basis over the next 12 quarters.
again, as a non-call report expert, I would assume with implementation of new accounting guidance, there would likely be a line to reflect that, with or without the capital deferral thing. I'm not sure with previous accounting standards if that was the case or not, but I know they're usually pretty good about having it all broken out, what changes in equity and retrospective adjustments, and if we had audit prior period adjustments. I know there's lines for all those things. Jeff, I know we had, started putting together all these questions that we've been gathering over the last, few years. I've sort of jumped around on these, and we've kind of answered others that have been brought forward by the audience. Is there anything else that you think would be very important to keep in mind as those on the call move towards implementation?
There's one other thing that comes to mind in these as we get towards the end of our time together here, and that is questions about, is there something, a document that I can use that's in plain English to help explain this to my board? Especially to the extent you have people on the board who are not, technical accounting people. This can sound like a foreign language, for sure. We have not seen something that I would say is comprehensive. There's really high level, super high level summary documents that sort of talk about what CECL is conceptually. If you want to, the challenge with this is it's just complicated. So to have like a 2-page document that gives the board everything they need to know about CECL, it's going to be super high level and not get into the details. If you want the board to understand all the details, giving them a document that's 30 pages that gets into all the details, they may not have the attention or the interest in reading such a thing. So what some organizations are defaulting to is to have a separate session on the agenda, if you haven't already, related to CECL, to go through it with the board, maybe a half an hour kind of thing, to sort of explain your CECL journey as well as what the rules require, and really focusing on the key assumptions and elections that you made along the way, and what that means for the ultimate result. So unfortunately, simply handing a document to the board and saying, here's everything you need to know about CECL, we're finding that in practice, that's not really practical. And what we're finding is that folks are actually putting these on the agenda and talking through it with the board. Again, not every detail, but enough so they understand the key assumptions and the key elements that gave a rise to the ultimate results. So again, to the questions about, can I just hand something to my board and have them understand CECL? The answer is most likely no. But having that conversation is worthwhile if you haven't already.
Yeah, Jeff, I think that's a good note. And I know Jamie and I are preparing a presentation for next month at a New York State event with directors, and trying to go with basic, not technical overview, very high level, and then basic discussion about the impact of CECL, why CECL is different than the ALLL, or change the ALLL to the ACL, and then ongoing monitoring, what questions they might want to consider asking. And I know, I've been to enough board meetings to know that there's generally 1 or 2 really sharp CPAs involved that ask the hardest hitting questions of us when we're there. But this would be structured more towards everyone else that doesn't necessarily understand all the accounting background and impact that may be involved. So we'll after we get that together, I think that would be hopefully a piece of documentation we could circulate as well that may or may not be helpful in your organization. So stay tuned. And the FAQ, we're gonna vet it internally, probably throw 7 pages of disclaimers on it before circulating that as well. Any further questions before we adjourn? Well, thank you all for attending. I know we talked a lot, but I do appreciate the questions and comments from our audience as well. And we'll continue to try and schedule these every few months. If participation and registration remains, I think, you know, the general idea originally for these was we get a lot of questions, and we don't necessarily have all the answers, especially when it comes to the more nuanced items. And maybe it would be good for peers to get in the room together and talk about it. So feel free to, you know, continue to bring your questions and send them along, and we'll try and cover them in each subsequent session if and when those occur. But for now, we'll continue to try and schedule these at least every other month. Everyone have a great afternoon.
Thanks, everyone.
Thank you. Thank you very much.